What is the risk you are taking when investing in bonds? How can you minimize this risk? Investing in bonds isn't the action-packed choice you'll see in movies about Wall Street. Yet, it's often presented as the tortoise in the tortoise and the hare story. Slow and steady, but with potential risks that don't seem obvious, especially if you are rolling your eyes at the latest meme stock drama. So, let's break down the risks. First, there's credit risk. This is the risk that the bond issuer will face financial difficulties and won't be able to pay the interest or principal back. Think of it like lending money to your friend who's always bragging about his next big thing. You know, the one that never takes off. Then you have interest rate risk. Bonds have an inverse relationship with interest rates. When rates rise, bond prices fall, and vice versa. It's like a seesaw you can never quite balance because you're not the one deciding who sits on the other end. Inflation risk is like that sneaky pickpocket you never saw coming. It reduces the purchasing power of the money you'll be getting back from the bond issuer. The money that sounded great 10 years back may now barely buy you a cup of artisan coffee in a Portland cafe. Lastly, there's the liquidity risk. Some bonds can be harder to sell than tickets for a Fyre Festival comeback tour. These are the ones you'll struggle to find a buyer for if you need to cash out. So, how do you play it safe while investing in bonds? Diversification. It's the oldest trick in the book for a reason. Don't put all your eggs in one basket, or should I say, don't invest only in bonds from a single issuer or with the same maturity date. Mix it up. Corporate bonds, municipal bonds, treasury bonds. Keep it diverse like Portland's food cart scene. Also, consider the duration of your bonds. Shorter-term bonds are less sensitive to interest rate changes than longer-term bonds. It's like choosing a sprint instead of a marathon because you want to see the finish line sooner rather than later. Inflation-protected securities can also guard your investment against that sneaky pickpocket. Treasury inflation-protected securities, TIPS, are designed to grow with inflation and cushion your money against the declining value of the dollar. And finally, stay informed. Keep an eye on the credit ratings of the bond issuers and the movements of interest rates. It doesn't require you to be glued to your screen like you're binge-watching a new show, but a little attention goes a long way. Bonds might not be as glamorous as other investments, but they can be dependable performers in your portfolio if you play your cards right. Now, I'm going back to enjoying the misty serenity of a walk along the Willamette River. Sometimes the best investments we make are in moments of peace and reflection. Am I right?